The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box Europe with Karen Cho and myself, Steve Sedgwick, and these are your headlines. European stocks are seen sharply lower amid an intensifying global sell-off. Investors now bracing for economic data releases out of the United States after the end of the government shutdown.
The big tech names come under renewed selling pressure as fears around overstretched AI valuations grip markets once again. And Bitcoin sees its gains for the year wiped out, with investors fearing a deeper rout could lie ahead. The European Commission upgrades its growth forecast for 2025, but warns government deficits are set to rise over coming years, while the bloc could be hit by a downturn in markets.
We are also highlighting this as a downside risk for our economic forecast. As regards, for example, equity in the technology, including AI sector, it may affect negatively investor confidence and financing conditions.
We've gone from a period of ferocious buying to some vicious selling in parts of the market. What is curious, we were setting up for a very big trading week already on the macro front, from the data to Nvidia, but the market not waiting it out for that information. The fears about the AI bubble that has circled back into markets again. What is interesting, though, is if you look at the overall averages, the pullback still somewhat modest. The Dow, for instance, down to the tune of 1+%, less than 1% coming off the S&P 500. The Nasdaq down only about 0.8%. So we are seeing a vicious trade in some parts, and that is very much concentrated around some of the tech names, but Bitcoin in particular in the crypto space. Let's just take a look at those tech names first up, and you can see the extent of it. I mentioned Nvidia, the outing we're expecting to see this week. Many think it'll be a beat still on the numbers, but the amount of capex spending we've seen from some of the hyperscalers, that is a question that is dangling, as well as the reliance on credit markets to try and fund some of this build out of AI. This is the state of play as we saw the wash up yesterday. Again, the ranges on the back of what has been extraordinary buying in recent weeks. It is still a fairly modest pullback in that context. The most of it really around advanced micro, down about 2.5%. Bitcoin, this is where it gets real. We've seen the gains so far from this year wiped out. So the trade now lower than where we started out 2025. And the extent of that reversal very strong. The 89,000 handle is where we sit this morning. So I'm just going to hand it over to you, Steve, because I think you'll probably have a view on just where we sit today.
I'm trying to work out whether the Bitcoin story is an outlier or actually is driving the market. And we spoke to John Blank at this time yesterday, and we'll speak to Mike Gallagher in a few moments' time. But the question is, what's going on in Bitcoin and how related that is to the rest of the market? There's no doubt about it. Bitcoin is a rout. We are in a deep bear market now. We're down the best part of 30%. And it's been exacerbated by a lot of things, despite the institutional support, the regulatory support, the ETFs coming on, the Trump administration being very friendly. The fact of the matter, and actually, dare I say it, many people thought it was a diversifier away from fiat currencies. Well, it doesn't appear to have ticked any of those boxes. The fact of the matter is, leverage has been a real problem for this, and there's been forced liquidations which have followed the macro event as well. CNBC's done some great copy on this on the website. So I'm watching this one, but it is at the moment a very small asset class compared with the global bond markets and global equity markets. So going back onto your point about it being a very small decline so far, I think you're absolutely right. I think the fact that Nvidia over the past month is still up. Let's just get that in context, ladies and gentlemen. Nvidia is still up a couple of percent over the last month. In fact, over the last 5 days, just looking at the CNBC website now, it is only down 4%. Now, if we were talking about a bear market for AI, wouldn't the poster child be down more than 4%? I'm not saying that things can't get worse. I'm not saying that there aren't over-valuations in AI. There could well be. That is not for me to say. But what I am saying is, so far, you have to put this in context to where we have been. And where we have been is the fact is very high moves to the upside. One thing I will just add is this is actually not just about tech. When I looked at the big indices, and I looked at the same numbers you looked at about the declines in the S&P and the Nasdaq and the Dow, then I had a look at the Russell 2K, which is small and mid caps, and I had a look at the Dow Transports, which is very often seen as an augur for broader economic health of the US. Those are the two indices that have had the big sell-off. So we cannot typify this as just a tech revaluation. The Russell 2K is 8% off its record high. The Dow Transports is in correction territory, down 13.5%.
If we pull the curtain back a little bit further, is it a story of too much leverage being shaken out? And that leverage really going back to the Bitcoin trade. There's been a lot of leverage bets in that area. We were talking to a guest yesterday that the triggers could be from Bitcoin across to the technology space. We know the retail investor has been very involved in Bitcoin, technology, gold. So you're seeing those areas of the market trapped up together. But so too is the institutional investor that's been chasing much higher returns. And I think as a result, my question today is whether this is a garden variety sell-off or whether it's something a little bit more than that. When it comes to the Bitcoin market, there have been references to whether this is a 10-10 event, something that was triggered back on the 10th of October, liquidity event, whether we're now dealing with aftershocks that carry on for years to come, or whether this is just a very short-term correction we're witnessing. If
you do want to see enormous declines, have a look at the Bitcoin treasury companies, the so-called Michael Saylor mimics of this world. And I'll just have one more thing. Do you know how many Bitcoins, cryptocurrencies there are out there? I actually always thought it was about 12,000, 13,000.
There's a lot, right?
George Steer and Jill R. Shah in New York for the FT said there are more than 18,000. More than 18,000. And we talk about Bitcoin and Ethereum ad infinitum. No company will be immune if the AI bubble were to burst. That's according to the Alphabet chief Sundar Pichai, who told the BBC that whilst the surge in AI investment had been an extraordinary moment, there was some irrationality in the markets akin to the dot-com boom. Peter Thiel's hedge fund exited its Nvidia stake in the third quarter, a position worth $94 million during that period. That was the fund's biggest change by value during the quarter, whilst Thiel retaining also stakes in Apple and Microsoft and a reduced position in Tesla.
Conflicting lines out of the Federal Reserve overnight, with officials conflicted over whether to cut rates at next month's meeting. Governor Christopher Waller is on the side of a cut next month, saying he's concerned about the labour market with hiring sharply down, while the vice chair of the central bank, Philip Jefferson, called for a more moderate approach, saying the evolving balance of risks underscores the need to proceed slowly. Mike Gallagher, Director of Research at Continuum Economics, joins us now. Mike, we've just touched on various different points that are sensitive for markets right now. That is the tech story, it's the leverage side around Bitcoin, and it is, of course, monetary policy, whether the Federal Reserve is still cutting or taking a time out here. What do you make of some of the market fears that exist today? And can you marry that against the macro and whether that genuinely is a concern in your view?
So I think, let's step back a little bit. We've had a great run in markets since April. Come this time of the year, people do take a little bit of profits because then they don't know what's going to happen next year. So I think this is kind of natural profit taking. It's obviously, as you say, in the crypto market, there's a lot of leverage as well, which has exaggerated the moves. But in equities and in gold, there's probably still going to be some more profit taking. Is it a major catalyst that's prompted this? Not really. People are sort of saying they don't think that the Fed will now cut in December. We'll have to see what the data brings. It's still a close call. But for next year, we're probably going to see the Fed pause in the first quarter, maybe the first half of the year. And then all of a sudden, that kind of driver that's helped risk is no longer there. We've also got the Supreme Court in the US due to judge on Trump's reciprocal tariffs. It's actually a 50-50 call whether that part of them or all of them are stopped. And that then gets us back into April's psychodrama about new types of tariffs. So there's some things coming over the horizon that make you want to take a bit of risk off the table. So part of it is just natural profit taking. Part of it is thinking, well, is the macro story going to be perfect? No, it's not.
Mike, we could say that those same risks were lurking over the course of 2025. There's been no shortage of risk this year, but investors have largely ignored some of those concerns and they've been very bullish, buying stocks, buying risk. The reality now is that we've got a retail investor that has been buying every dip, and that is what's changed. Instead of the old sell-off where we get a correction, we get a pause for thought, and then we grind back higher, we've just popped straight back up every time thanks to the retail investor. Is this time any different?
I think at the moment it looks like just a normal sort of correction, which in equities might be sort of 5% from the top downwards, might be a little bit more. But if you look at the AI story, we've just gone through sort of earnings seasons. The big sort of hyperscalers are getting lots of revenue coming through in 26 and 27. People are looking at Meta because they don't have a server business as a proper catalyst and a proper indicator of whether the next level of AI applications will generate good revenue. But that story is still probably going to be there come the early part of next year. So that kind of sort of suggests it's just a normal sort of correction, a healthy sort of correction. But there are things in 2026 that will make it a bit heavier going.
You say we've had a lot of AI results. We've obviously got the daddy, the mummy, whatever you want to call it, NVIDIA coming out in the next 24 hours. So that's going to be unbelievably exciting. Mike, I want to go back to the genesis of this crisis. And we've talked about liquidity and we've talked about leverage. But the thing that the CNBC copy that I was looking at saying this started off as a macro event because of concern that rates will not be cut quickly enough. What I want to know is, given that this is such a huge thematic story of our times, and no one is denying that AI is changing everything, it is going to change everything. How tight are the finances on these tech companies, both listed and unlisted, that a quarter point cut in interest rates can have such an outsized reaction on the markets? If this was all about whether we're going to see a DEC rate cut or not, which it's not all about that, of course, but that was generally what's being talked about in the commentary. It worries me of how tight the finances are of these companies.
So I think if you look at the Magnificent Seven, they are generally sort of overvalued on their own sort of metrics, if you look at forward price earnings ratio. So anything that comes along that's moderate bad news, i.e. the Fed maybe not delivering a cut. We're getting outsized reactions to that. But I think that's just a correction to us. I think to get a major sell-off, you may need major bad news. And that we haven't actually got to that point yet. So if the Fed don't cut in December, they may well just delay till January. And that's going to be the mood music from Powell, if that's the case. It's not a disaster because the bond market will still believe that the Fed will continue to cut interest rates next year towards 3%. The only disaster for the bond market would be if we actually got the Fed saying, no, we're definitely not going to do anything else. The dot plot's lifted. We don't think that's going to happen in December. So you're still going to get the carrot that's going to be there. So there might be a bit of short-term reaction like there is now that, maybe we're not going to get a December cut. But actually, okay, the carrot's still going to be there. Let
me ask you a very simple question. Now, I appreciate you're a director of research at Continuing Economics. You're not a trader in a pit. If I were to give you $1 million right now, would you put it in bonds, in equities, on some form of deposit account? Where would you put your money now, given everything we've seen over the last week?
So I think if we're looking at sort of 2026 as a whole...
You've got a long time frame on it. You don't have to make money on it before the end of the year.
2026 as a whole, we think that US equities are overvalued. We're going to see another correction next year. We'll probably end up at 6,600 for the S&P 500. We think India and Brazil are probably sort of the two markets that can perform really well next year. India on long-term corporate earnings, Brazil on rate cuts. The other markets, I think, are going to trade in line with the US equity market. So it's going to be a trickier year next year.
We did hear another EM call yesterday as well, so that is fascinating to see that you're in lockstep with that. Let me ask you about some of the AI concerns that really stem to the heart of relying on credit now, because it started with Meta and Oracle, the fairly huge amount of issuance they're relying on to build out the AI CapEx program. It is Amazon now joining the party, and that was what spooked the market again yesterday. A reliance on $15 billion in bonds is, again, fresh news for Wall Street to digest, that this is a build-out that is going to require a lot of debt. That's not new news, relatively speaking. We know that everybody's going to have to chip in, but how do we think about the market's reaction now to every single issuance that we get now from some of the Mag 7?
So I think one of the problems with the corporate bond market is that the spreads versus US Treasuries are actually quite tight. So what's actually
less than 1%, wasn't it, the other week?
So what's happening is that as we kind of get this heavier supply, the market's having to adjust and react. Spreads need to get a bit wider. They don't need to get dramatically wider. They just need to get a bit wider that then it draws in enough sort of institutional money. And I think that's the process that's going on. It's quite noisy at times, but I think it's a normal type of adjustment process that we're seeing. We're not seeing a big blowout phase in corporate bond spreads. What you'd need to do is you'd need to see the data over the next 2 months showing that you're going to get a hard landing in the US economy. Then we could get a more serious trigger in terms of corporate bond spread blowouts, a bigger correction in US equities. But that's not sort of showing up in the private sector data. If you look at the economic data that we've had in the absence of the federal data, it's showing a sluggish economy, but it's not slowing down dramatically. And looks like Q3 GDP is going to be around 3% in the US.
Mike, I'm very aware, and the viewers will be aware, that you didn't answer my question. So don't think I'll let you get away with that one. I was just pacing myself. But given what you said about the caution that you have as well, do you think that there are going to be better opportunities for our viewers, your clients, to enter the market? Would you be sitting on the sidelines now? I've kind of made it more nuanced rather than ask you directly what you can do with your $1 million.
No, I mean, I think there is certainly sort of catalyst, and the Supreme Court decision we're looking at, that could arrive before Christmas. That could be bad news for risk assets, including sort of equities. So we think there is another sort of potential big catalyst that can produce a sort of a pullback.
Let's go through the safe havens. Apparently, crypto isn't a safe haven. We've worked that one out now. Gold, bonds, and I'll say the medium to long end of the bond market, because I'm just going to park the short end. We all know that everyone wants to get in the short end. Do you feel that the medium to long end and gold can act as safe havens, given everything you've just said?
I think it's the yen, because the yen is very sort of undervalued. People have just been sort of bearish about it. So there is,
given the geopolitics we're seeing now with China and Japan?
I think that's just posturing between sort of China and Japan. I think China don't want Japan to be too assertive, so they're doing that. Gold isn't, because gold has attracted a lot of retail and speculative interest. So gold is seeing a pullback in line with the other riskier assets. Treasuries, yes, the long end of the market is a safe haven, because bond yields adjusted for inflation are at a plus 2%. That's pretty good normal valuations. So yes, it's a safe haven.
I think there's some relief in Japan about the comments you just said today after all the talk about possible intervention because of the weakening of the Japanese currency. So very timely for the Japanese. But let me just come back to what you've been saying about the Supreme Court and the tariff decision, because I wonder whether it is really front and central here for markets, because the Trump administration keeps on pointing out they rely on a ton of other different laws that they can enact. If that Supreme Court decision doesn't go their way, they can say, look, we're going to use this, we're going to use this different maneuver as well. So is it as pressing for markets to be thinking about that court decision? Not at the moment, but when it actually sort of arrives, if part of the reciprocal tariffs are rejected, then the Trump administration need to spend 3 to 6 months introducing 232 and 301 sort of tariffs, which are a lot more complicated to sort of introduce. He has to do arm twisting with countries that he's done a trade framework deal with, that he hasn't actually sort of done proper trade deals with, to try and get them to stick to that. It will cause volatility if it's part or fully rejected in terms of reciprocal tariffs.
Whatever happens, we have a very exciting job and we're very lucky to do it and to talk to people like you. So thanks, Mike. Mike Gallagher, who is Director of Research at Continuum Economics. Coming up on the show, the European Commission releases its autumn outlook, revising up growth for this year. Shall I say it again? That's exciting, isn't it? Revising up growth for this year. But warning of turbulent times ahead. Thank you. We didn't notice. We'll bring you all of those details. Plus, the pain continues for risk assets. Bitcoin has now wiped out its gains for the year. Traders scrambling for further downside protection, which is interesting because they didn't do it at the top, did they? And elsewhere, we're going to speak to the co-founder of Ethereum, Charles Hoskinson, at 7:45 London time. Plus, Emirates bets on Boeing in a deal worth $38 billion. Dan speaks with the airline's president, Tim Clark, at 8:30 London time. Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick, and here's the CEO of Siemens Energy, Christian Bruch.
Business leaders should not stay quiet in a world which is super complex. We sit in a privileged position, and we have to use that to ensure that a society remains prosperous, stable, successful.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this. Okay, there you can see the US futures looking like they're on the back foot yet again. We're tracking some of the biggest movers in pre-market trade. ABB hiked its profitability margin goal to as high as 22% amid the sale of its industrial robotics business to SoftBank. That's an upgrade of as much as 6 percentage points as it focuses on automation and electrification. Crédit Agricole set a new profit target, a net profit target of €8.5 billion, above the 8.2 billion analysts had penciled in. According to Reuters, the lender has a reputation for setting conservative targets. And Havas CEO Yannick Bolloré has reportedly denied being in talks with WPP about an investment in the company. This, according to Bloomberg, and comes after reports Havas was interested in the British advertising group, sent shares as much as 13% higher in Monday's session. Axalta Coating Systems announced it will merge with the Dutch paint maker AkzoNobel. The two companies will combine in an all-stock merger worth $25 billion. Axalta said it will also suspend any ongoing announced share buyback programs immediately. And Novo Nordisk has cut the price of its flagship Wegovy weight loss drug in the United States and made the first 2 doses of the drug available for just under $200 per month. The move will see Novo Nordisk offer the weight loss injection at a lower price than rival Eli Lilly's Zepbound. Never heard of Zepbound. The company is also shifting focus to the pill version of Wegovy, with a decision from US regulators on the drug expected by the end of the year. The CEO, Mike Doustar, told investors the company is ready to go, quote, all in and has more than enough pills available.
Semiconductor and lights maker company AMS Osram beat estimates for its third quarter earnings and revenue, boosted by its chip business. The company, which is based in Austria, posted €853 million in third quarter revenue. It reiterated its full-year guidance. Annette spoke to CEO Aldo Camper and asked him about his expectations for demand.
The main thing that we see is that our automotive customers, and automotive is a major part of our business, are ordering very short term at the moment. We do see overall demand being okay, but obviously the mix of what our customers want to build and need to build is in flux, and we need to respond to that very actively. That's one of the key challenges. On the profit side, a key challenge is the very high gold price. We use quite a bit of gold, and gold keeps going through the roof, and that is a significant burden that we need to deal with as well.
Camper also spoke about the importance of having an active presence in multiple markets.
It's important for us to have a well-diversified setup globally. And we have, I think, a very healthy setup in our supply chain with a major site in Germany and in Austria, and at the same time, very cost-efficient locations in Malaysia and in China, for example. And I think that global footprint serves as well, especially given the global tensions at the moment. With that, we can respond well to the various developments.